So let's move on from that. Europe has slowed down a bit this year. You can see in the chart there, manufacturing conditions, PMI, business conditions, in other words, have slowed a bit, but they're still at reasonable levels. And again, I don't see anything driving a recession in Europe. I don't see Europe, the Eurozone, breaking up. Yes, there's some concerns about Italy, their budget, and Germany with Merkel on the way out. But note that 83% of Germans want to stay in the Euro. They like the Euro, and around 60% of Italians like the Euro. So I reckon they will stay in there, although you occasionally get a bit of noise about it. What about China? Obviously, it's slowed down, can't grow at 10% forever. This year, it's slowed to about 6.5%. It may slow a little bit more, but the Chinese authorities are conscious that they don't want to let it slow too much because it results in social unrest. And therefore, our view is, yes, it might come down a bit more next year to 6.3%, but we don't see a collapse in the Chinese economy, and we'll probably see more stimulus measures coming through, tax cuts and the like. So I might just jump over that chart there. Just let's look at the US. So this shows US unemployment down at 3.7%. That's the lowest since 1969, which out of interest was the second year of the Brady Bunch. For those of you who don't know the Brady Bunch, you should find it out. It inspired a lot of my career. Initially, when I got some money, I went up and bought an American convertible, but it wasn't quite as good as the one in the Brady Bunch and just ended up costing me a lot of money. But they don't make convertibles like that anymore. They were good cars. You could fit 3 people in the back. These days, you struggle to fit 1 person in the back in relation to their legs, which get all squished. But anyway, US, very low unemployment. That's led to a very tight labour market. That's leading a pickup in wages growth. But look at the wages chart. It's only got to 3.1%. We'll get an update on this tomorrow night. 3.1%. Historically, before recessions in the US, which are shaded in grey, it needs to get above 4% because that's when you get inflation problems. The Fed slams on the brake. We're a long way from that. And at the same time, the Fed's looking around and saying, well, we've raised interest rates. They're almost getting back to what we think is neutral, which is somewhere between 2 and 4%. I don't know quite precisely. Getting close to neutral. Housing market in the US has cooled off a little bit. Yeah, maybe we can afford to go a bit slower through next year, and which is what I think they will do. So they will probably hike in a week's time, or is it 2 weeks' time? 2 weeks' time. So make it 4 hikes this year. But I reckon the signal coming out of the Fed is that they're getting closer to a pause, which they'll probably do through the first half of next year, which will be a good thing. If the Fed stops raising interest rates, it's going to dampen down some of these fears about the US going into recession and also dampen some of the upwards pressure on the US dollar. Probably won't help the Aussie dollar, but it may help emerging market currencies. So that's the interest rate story. Maybe a bit more upside in the US, but getting close to a pause. Other central banks on hold. Well, they're at zero anyway, Europe and Japan. And Australia, I'm actually thinking, will cut rates next year. Big issue for investors always is where we are in the cycle. A lot of people saying we're late cycle, that the US is at the top, about to come down the other side. Out of interest, China, emerging markets, they're down at the bottom of the cycle. They've had a huge fall. Chinese shares down 30%. But again, that debate is around where the US is, and I reckon they still don't have a major inflation problem. I don't think interest rates have gone up enough to cause recession in the US, so I think there's still a bit more left in this US upcycle here. And I'll come back onto that in a moment because it's quite important.